So, if you are new to investing in the markets, or maybe have just been trying unsuccessfully, covering some basics for stocks, options, and risk management is what we'll be doing here today. This video is more about bringing up terminology, concepts, and ideas that are really meant to start planting seeds in your mind. So, let's get it going. When building a house, you want to have a strong foundation. But we aren't even talking about foundational stuff today. Today we're just going to be talking about what kind of house we would like to build. Basically, pre-blueprint. This starts getting thoughts developing about the house we want to build. Do we want to build a 3-bed, 2-bath, 2-story? Do we want to build a 4-bed, 3-bath ranch style? Do we want a townhome? You don't just start putting blueprints together unless you have an idea of what you're going for. So alright, let's get started with some basics for stocks. So stocks are simpler than options. Think of the game checkers. With the game checkers on a board, you can basically jump one direction or the other diagonally. But that's pretty much it. It's pretty straightforward. So they reflect ownership of companies. They can receive dividends. They're pretty liquid. Now the price of the share is the price you pay, unless you're using margin, which is leverage. There's 3 ways to make money. 2 are directional and 1 is passive. Long, which is buying, you make money as the stock goes up. It's great for swing trading, which is multi-day to multi-week trading, and investing. Short, which is selling, and this requires a margin account, makes money as the stock goes down. It's great for day trading, given certain conditions are met. Dividends are the passive way to make money with stocks. They occur as cash payouts that can occur quarterly, biannually, annually, or a special dividend. The most common one will be quarterly. Now you need to own the stock before the ex-dividend date and through the date in which dividends are paid. Now let's talk some basics on options. Options are more complex. Think of the game chess. Pieces can go forwards, backwards, left, right, and many pieces have their own movement type. Options give the buyer of an option the right to do something, either call away or put to somebody with the underlying asset by the expiration date. Okay, so let's talk about some things with options. So like I made the comparison to chess. Options have many different moving pieces. They have a time piece, they have a volatility piece, they have a delta piece, which is the relationship of how the option moves, the price moves up and down with the relationship to how the stock or underlying asset moves up and down. But the most important part of this is going to be the expiration date, especially as you see here in this definition. So the expiration date is a set time that you have to do something with the option by then. Now this is different than what most people are used to in the stock side of things, and is probably the biggest component that makes options different. There is a point in time in the future that this position will end, regardless. Like 100% it will end. Now you can close the position, you can exercise the position, call away or put to somebody shares, or you can roll it, which is basically closing the position, just opening a new one. But if you do that simultaneously, we just call that rolling. I'm going to give you a real quick analogy about how to think about time and how to value it, okay? So I remember back when I was in middle school, my science teacher gave us this experiment, I guess to say. But she said if you go to the store and you look at bread, you got some cheap bread and you got some expensive bread. More expensive bread might be kind of the same kind of wheat bread or something comparable. But she said if you look at that cheaper stuff, it might spoil in a week. Although if you go to the little bit more expensive bread, maybe that spoils in like 3 weeks or something like that. And I do remember one student asking why that is, and she said, well, they put bacteria in the bread to make it last longer so the fungus doesn't grow on bread and doesn't spoil as quickly. So I remember that from my science class, and it kind of applies perfectly here. So and how that kind of relates to options is as you're buying more time, it's going to be more expensive. So as you're buying for some bacteria to be injected into the bread so that it lasts longer, here you're going to buy more time if you go farther out on the expiration date, which will then make the option more expensive. Okay? Now, many of you I'm really starting to make these videos for know that I know options very well, and I will be making some very detailed videos on options later on. But I just want to give you guys some brief injection of some terminology on options because there's a lot to cover, and so I just want to start getting some drops in there for kind of like how options work and that kind of thing. That way, later on, it can kind of go a little bit quicker. You can start to pick it up a little bit faster. I'm not dropping basic concepts on you, and then right after that, I'm dropping more advanced stuff on you. But options are a lot of fun, and this is where, if you use options correctly, they can really take your portfolio to the next level. Um, way more than stocks ever could. Stock picking. So um, yeah, options are going to be a lot of fun. Now, four things are needed to be able to identify an option: an underlying asset, which is a stock, commodity, etc. For the purposes of this channel, we mostly be talking stock and stock options. You also need an expiration date, a strike price, and whether it's a call or a put. Okay, I'm going to talk a little bit more about call or put. I know I mentioned up top, we're talking about the definition of options that you can call away or you could put to somebody, the underlying asset. But that's really like the exercising of the option if you choose to go that route. To be perfectly honest, that doesn't normally happen in options. It does happen. So it probably will happen to you if you sell options. If you get to that point in time where you have enough capital in your account, and you want to call away or you want to put to some an asset, you'll probably use this. But most options are traded, especially with the onset of online brokers, and it has made trading more accessible to individual investors. And options is one of the ways that allows individual smaller investors to have a little bit of more leverage with the risk still a little bit more managed. Okay, and we'll go into that a little bit later. But real quick, a call is basically if you buy a call, you want the underlying asset to go up in value. That will increase the value of your calls. Okay. Now, put is the inverse. Okay, so puts are always inverse to calls. So if the underlying asset goes down, your puts will go up in value. Okay, so I will cover this in much more detail later on, but I just want to give you that real quick, brief calls, puts, what's the difference. Calls go up in value as the underlying asset goes up in value. Puts go up in value as the underlying asset goes down in value. Okay, so we'll cover that in more detail later on in some later videos, but we'll just keep it moving for now. In order to value an option, you also need to know a volatility calculation. There are two types of volatilities: historical and implied. Historical volatility is calculated based on the previous price action of the asset. If the asset starts to have wilder price swings, the historical volatility will start to increase. Implied volatility is a theoretical calculation. It has more to do with future expectations, such as upcoming earnings releases, expected product reveals, government announcements, etc. So think of Apple announcing a new product or a pharmaceutical company waiting government approval. Okay, so hopefully seeing and hearing me talk about everything just to do with options here hasn't scared you away. There is a lot to cover in the world of options. Now, I'm going to give you some brief examples on how to make money with options real quick, but this is like the tip of the iceberg. Okay, so as I mentioned earlier, calls go up in value as the stock goes up or the asset goes up. So some basic ways that you can kind of make money with options is if you think the stock has a good setup to go higher, then buy a call option. But if you think the stock's going to go down, well, you can buy a put option. Okay, now that's kind of some basic understanding of how to use some options, and some strategies. Some other cool things about options is that whenever you buy options, typically the floor of your risk. Like when you buy an option, whatever you buy that option for, that is pretty much your max risk. You can't lose more than that. Okay, so if you buy an option for $200, you pretty much couldn't lose more than $200. Okay, so that's kind of the nice thing about them. There are other ways that you can generate income using options. You can sell options, which allows you to collect premiums instead of buying options. You can collect premiums, and knowing how options work across the time and cross time decay and those kinds of things, this really allows you to combine some strategies and with stocks and options and really make a dynamic portfolio that makes a lot of return and generates a lot of cash, that you can reinvest and keep it going and compound, or if you're retired and you want to live off some cash flow, this is also going to be another great thing for you. And I've never, the strategy I'm going to get to later on, I've never seen anybody teach or explain or anything even close to it. But there's another strategy using options that's very basic one. You'll see this around, which is the covered call strategy. I don't like this strategy too much, but it depends on the stock you're going to do it on, and I get that. I don't like doing that strategy simply due to the fact you are limiting your upside in the asset, in the stock, right? So if you're going to sell a call a little bit above where the stock is currently trading and collecting premium, then you are also limiting your upside. But just know that there are many different strategies out there to utilize in a portfolio to make great returns with options. Okay, options are really one of the biggest ways, big time funds, mutual fund, like Warren Buffett uses a lot of options, believe it or not. Like everybody's like, he's a stock picker, he uses options a lot. You just don't hear about that because everybody focuses so much on the stock picking. But this is going to be the way where you're going to earn a lot of money. Okay, a lot of money, a lot of returns, and but I really do look forward to getting into this and showing you like where to position on buying options and selling options, and the different kind of strategies to use and when you should use them and that kind of thing. So yeah, we'll leave it there for now. And then, but I really do look forward to getting to this. And I know I got a lot of friends that are really looking forward to me covering options. And I look forward to hearing some of y'all's feedback on if you're following later on or not. But we got to cover a lot of basics before we get there. Because one thing that I kind of realized as I was doing some of these videos is to cover options correctly, we got to do a lot of basic stuff. And it's kind of a bummer, but it is what it is. You really do need to start out with a strong foundation and then move to the more advanced stuff, or it just won't work out for you. Risk management. This is the one thing that will keep you in the game. This is as much about mental preparation as it is about plan and strategy implementation. Don't fall for the mantra of risk it for the biscuit. This mantra has taken over many aspects of society, and has no place in trading, as it is mostly a gambling narrative. So you want to try to keep your risk per trade around 1 to 5% of your account. So how you want to calculate it is take your total account value and times what you deem it your risk per trade should be, whether it's 2%, 3%, and come up with the dollar amount you want to risk per trade. Your best friend is going to be the stop loss. The other part is you just need to know your limits. Some limits are going to be mental, and some limits are just going to be numbers. Whether the limits are limiting you to how many times you trade per day, per week, you also need to have limits for your take profits. You also need to have time limits if you're in option strategies. And probably the best way to implement risk management is to automate as much as possible. The more you can be like a robot, the better off you'll be, as trading is really just a numbers game. So hopefully you heard some new things here and start getting an idea of what's coming later. But like babies, we have to understand the concepts of standing and walking before we can start crawling and sitting up. See you in the next video. Good luck investing out there.